Good afternoon, everyone, and welcome to the first panel discussion of the Phenix Virtual Investor Connect. I hope you're healthy and safe during this second corona wave, and I thank you for finding the time to join us today. In this panel, we'll look at aligning portfolios with NetZero and the implications for asset allocation. But all throughout these next 3 days, we have about 240 individual Investor Connect meetings going on between asset owners and fund managers. All of you have already been muted, but still, we highly encourage you to ask questions. This is meant to be an interactive session, and our panelists are excited to react to your ideas and concerns. To do so, please submit your questions in the Q&A box at the bottom end of your screen. It is up to you to send them anonymously or not, but the second point, this is a recorded session and it will be circulated afterwards. Always good to be aware of. With that, I'll run you through the agenda for today. We have with us the agenda is aligning portfolios with NetZero, implications for asset allocation. The NetZero Asset Owner Group has been convened by the UN and has gotten a lot of traction. 30 of the members, one of them is part of this panel. We have them here and we're very excited about this initiative. It is very important that we move not only the whole economy, but also investment portfolios towards net zero. And it's great to see that some of the largest asset owners of the world have been committed to this. So, as speakers, we have with us from the US, Richard Zimmerman of We Family Offices. Richard is a relationship manager there. He advises the firm's ultra high net worth client families regarding their overall wealth management needs. And he also helps lead the firm's values aligned investment service, which incorporates a family's values into their investment and philanthropy through impact investing and grant strategies. From Australia, we have Radha Kuppalli from New Forest, where she's a managing director. Radha leads New Forest Investment Services business unit. She is responsible for integration of responsible investment and ESG into the investment strategy, client relations, fund marketing, thought leadership. And finally, out of Germany, we have Sonja Statelmeier-Petru of Alliance Investment Management, where she's global head of sustainable investing. Sonja leads sustainable investing across Alliance global portfolio of proprietary assets focusing on strategy development and implementation, project management, fund investment, and entrepreneurial endeavors. So not only 4 different regions, but also 4 very different perspectives we have here, from a family office, a fund manager, and a large insurance company, and of course, us at Phenix as well. Let me start by asking Sonja, as one of the Alliance members, on why they wanted to come together and create this Alliance in the first place. Sonja.
Thank you, Derek, and hi, everyone. Also from my side, I'm very happy to be here. Thank you for the invite and for the interest to discuss and hear what we're doing at Alliance, but also within the Asset Owner Alliance. So, Derek, as you already mentioned, we are currently 30 asset owners who came together and are representing roughly 5 trillion assets under management. And kind of the exciting part about this alliance is that all of us committed to have carbon neutral portfolios by 2050, alongside the 1.5 degree pathway. And your question to why we got together, I think, kind of came naturally to us because each of us was, I think, independently already looking into how can we decarbonize our portfolios, and kind of looking at science and looking at our portfolios. We know that, and this is now a rough estimation, in order to be in line with the 1.5 degrees, we need to cut the emissions that we have in a portfolio in half every 10 years. And so if you think about it, and if you kind of think about the portfolios and also what needs to happen, we figured that it's not going to be enough if each of us kind of, on the one hand, do it separately, but also it's not going to be enough and sufficient enough if just the asset owners move into this direction. So the Alliance is, or kind of provides and coordinated actions for us as asset owners, but we also want to involve and kind of move other parts of the market. So policymakers, I mean, these are the stakeholders that we also need, the asset managers, the corporates, etc. So in order to really move the market and to really actually even move beyond our portfolios, but to have a real world impact, which is kind of the big aim and the big target, we decided that the best way forward is to collaborate, to really get together and together also develop approaches and ways how we can achieve the decarbonization.
Well, that's great to hear. And yeah, I mean, halving every 10 years, that's quite an ambitious target, I must say. And we'll go into that a little bit later in the panel. Before we dive into the panel discussions, we do have a quick poll. It should end up in the screen pretty soon. I'm looking at the directors here. Do you expect your organization's investment portfolio to be net zero by 2050? Please fill it in and we'll share the results later during the panel. So for today, we will start by looking at some of the tools and challenges. Then we'll look at the asset allocation part. And after that, we'll look at measurement and reporting. And at the end, there should be time for some Q&A. So please send any questions you have for the panelists to the Q&A box. But let me start with tools and challenges. Richard, do you see an interest with US families in moving towards net zero? And what are some of the key challenges faced by families that want to make that transition in their portfolio?
Thanks, Dirk, and thanks everybody, and to my panelists and to the participants. This is very exciting. So, as Dirk mentioned, I work with U.S. and non-U.S. families, very wealthy families, and a number of them have wanted to, or have started or are starting to express their investments according to their values, and that could be in ESG or impact investing in private directs. US and non-US. So, and we can talk about that later in structuring and how one can do it. But there's a growing trend in general to start to invest in these spaces, whether or not you're doing it as a part of your values or because you feel like this is a trend that you want to be part of for a lot of other reasons, including just how the world's moving and smart investing. And I would say that getting to your question, there's been movement among our families, but also anecdotally around families, and other kinds of investors globally, and certainly in my viewpoint in the US for ESG. And that's, very important for more corporate citizenship, better behavior, governance, et cetera. And also thematic. And the thematic trends have been very socially oriented, but also environmentally oriented. And my concern over the last year or less than a year since COVID was that the environment may take the back seat. I'm very happy that social is very up front, but it hasn't. In fact, all the signs that we see is that there's a real movement from all angles into the environmental space, and then as part of that into the climate space. So we actually do, and we'll talk about this, but climate aware investing, which helps families invest according to what's going on in the climate, sort of to reduce risk and to get into into opportunities. With net zero, I think that's, my sense is that is something that is becoming a new topic, at least in my part of the world. And maybe a little bit more at the NGO, government, and larger institution side of things, even as Sonia mentioned about the Alliance. And so I haven't seen it as much in terms of just the standard conversations among investors or managers, but we're starting to see it come in more and more. And so there is to summarize, there are more and more families who want to invest in the broad space of ESG and impact investing, and in both social and environmental. There's a greater awareness in wanting to move to climate. And then I think net zero may be kind of a rallying cry in essence, or a way to focus all of this. So I'm excited about it, and I think we're going to talk about that later. I don't know how much time I have here, Dirk, but you mentioned challenges, and one of the things, and I think we have managers on the phone, money managers, corporations, there's so many different ways to express this area of investing that it makes it difficult to try to get around it and to have sort of a common framework. And that's both in terms of the type of investments, the approaches, the measurement. So on the one hand, I think that's very good for innovation, but eventually, hopefully, we'll move to some common terminology, common measurement, and maybe it'll all pivot to net zero, which is a whole another deeper topic about impact and measurement.
Yeah, no, thanks, clear, and yeah, I share the concerns and your hopes as well in that area. Radha, in order to move investing towards net zero, increasing the allocation in forestry may be one of the most straightforward solution. It's definitely the first one that came to my mind when I heard about this Net Zero Asset Owner Alliance, but not all forestry investments do have the same impact. So how, from your perspective, how can asset owners ensure that their land and forestry investments contribute to the best towards this goal? Do they need specific tools, or where's the investment most needed?
Yeah, thank you, Dirk. And I thought maybe I can even just give a little bit of context as to, you know, why am I here from a forestry perspective. So really, in addition to a transformation in the energy sector, the net zero emissions transition is going to also require a complete transformation towards sustainable land use. So all of the climatic modeling that keeps warming, you know, below 1.5 degrees Celsius has all shows, you know, hundreds of billions of hectares of, hundreds of millions, excuse me, of hectares of reforestation around the world, which will require, you know, hundreds of billions of dollars of investment in order to get to about 10 billion tons of emission removals from the forest sector per annum between now and, you know, 2030. But today, you know, something like 3% of climate finance goes into the forest sector. So there's just a huge disjuncture between those things. So really what we're talking about is land-based mitigation. So the conservation and protection of forests, better management of forests, working forests and agricultural lands, and restoration of degraded areas. So collectively, this is what we call kind of natural climate solutions. So it's a really critical piece of the net zero transition. So I think there's kind of two things, you know, in terms of your question around what do asset owners need to focus on. So I think the first step is really around ending deforestation, halting deforestation, and implementing best practices on your, you know, existing land assets. So there's a very strong advocacy piece here when it comes to, I think, halting deforestation. So ensuring deforestation-free commodities, deforestation-free supply chains. There's a lot of work being done by Ceres, PRI, a lot of the investment organizations around this. And I think that's where asset owners need to be engaging. From a best practices on working lands, this is really thinking about engaging with asset managers, engaging with companies to think about, you know, productivity, efficiency, ecosystem services, community engagement. All of this effort really focus on getting information about how are we using land in the most efficient and thoughtful way, balancing production and conservation. But I think in terms of your question about, you know, where does the capital need to go to? That's the next step, right? So we need to be proactively investing to create climate positive landscapes where we're integrating conservation, restoration, and sustainable production. I think there's kind of three things that we think about in terms of thematics under that area. So asset owners will really need to be thinking about a significant amount of investment going into emerging markets, particularly tropical areas. That's where we need to have a significant amount of reforestation. And that's where it's going to really require new ways of thinking about risk, blended finance, what have you, partnerships with DFIs. Secondly is getting investment models and investment strategies around carbon finance, where we're integrating say sustainable forestry with carbon finance, and there's both compliance markets and voluntary markets that are making this very real today, and I'm happy to talk about some of the ways that this is playing out in our own investment strategies in the US, Australia, New Zealand, and even in Asia. And I think even beyond just the real assets investment play, there is also thinking about, private equity and thematic plays around the circular bioeconomy. So how are plant-based materials going to substitute for fossil fuel-based materials? And thinking about things like food innovation and technology and agricultural production, all of which will, take pressure off of natural resources. Yeah. So I think the punchline here is that, we know that in the energy sector, we have to push towards renewable energy in the production, the built environment, transportation. So it's really thinking now about what are the investment strategies that we have to implement to get us towards that same analogous outcome in the land use sector.
What is the reason, if I may ask, why you mentioned that so much of this has to go to emerging markets?
Yeah, well, where we're having, a significant amount of ongoing deforestation really is in the tropical areas of the world, usually linked to soybean production or oil palm production, cocoa production. So one, that's where we have to halt deforestation. But secondly, that's where we have large land availability for restoration as well. And where it's going to be most cost effective to engage in that. It's also where we have biodiversity rich hotspots, what have you. Not to say that there's definitely opportunities in the United States, in Australia, in New Zealand, other mature markets. But we're also looking at, what's the marginal cost of emission reductions as well as we think about this. So it's a variety of factors.
Nice. Okay. And Sonia, quite an ambitious target by Allianz. Can you share some of the steps that Allianz is planning to take in order to get those reductions?
Yeah, sure. Happy to do so. So I think actually a couple of things were just mentioned. So I can maybe elaborate a bit on kind of the various targets and steps, because it's exactly, that's the point. Like, it's not only about, and I mean, it's all part of it. So it's, the new technologies, kind of new types of investments, but it's also to kind of looking at what do we have in a portfolio, how can we really help the companies to transition. So it's really kind of all those areas. So when we're looking at target setting, and we have just 2 weeks ago published the target setting for the Asset Owner Alliance. And till last week, it was still up for public comments, because we also want to, kind of get some feedback from the public. So kind of going through the target setting very briefly, you can kind of look at it that we have 4 different layers. So we have the sub-portfolio layer, where we say what types of asset classes do we going to look at first. And from this perspective, kind of looking at data that's available to us, and also kind of the approaches, we're going to look at listed equity, corporate bonds, and real estate. So these are kind of the 3 areas we're going to start with. But of course, we intend to enlarge, because as I said, in the end, the complete portfolio needs to be decarbonized. So we need to kind of quickly expand into infrastructure, into sovereign bonds, for example. But there, we're still not kind of there yet, and the approaches are not finalized. But this will come. Then kind of the next step would be to look into sectors. We're going to start with the highest emitting sectors, because I think there, it makes sense to kind of, kind of go quickly in there, and it will take some time anyways, but there we really need to act very quickly. So this is going to be kind of the second layer. The third one is engagement. So we have different levels of engagement, be it with the companies, be it with the asset managers, for example, where the engagement with asset managers we use as kind of a multiplier effect in what we want to achieve, but also in terms of sectors and also policymakers, because as I said, it's not going to be enough if kind of the framework is not there to also help and support the companies on their transitioning. So this is kind of the third layer. And the fourth one is we want to enhance inflows into areas where for now or into climate solutions investments, where I think very often for now it's not really possible for us to invest because I would say from the risk profile, these are usually investments, be it in emerging markets or kind of new types of technologies or new types of investments, where if we want to scale up those investments, we need to come up with new instruments and kind of new solutions for us. So blended finance is actually one of the instruments that we're looking into to say, okay, how can we de-risk those types of investments for us? And this could work via blending private and public capital. So these are kind of, I would say, the four layers, how we look at kind of different approaches within the portfolio and how can we go forward.
Oh, that's great to hear. And that's pretty comprehensive framework, I must say, to start with that already. And it's, would love to circle back later on the effect that has on the asset allocation, but good to hear you're looking at a lot of different ways to do this and starting with some of the low-hanging fruit that can be done immediately within the existing portfolio. If we look at asset allocation, which is our second key topic, Radha, from all the asset owners you are talking to, do you see an increase in their allocation towards land and forestry?
Yeah, I mean, I guess to put it into context, I mean, there's certainly been a steady drumbeat of increasing allocation to real assets, over the past 10 or 15 years. Forestry in particular is an attractive asset class because of its low volatility of return, steady cash yield, low correlation with inflation, good diversification. But certainly we've really seen over the past 18 months this kind of intensifying interest in forestry as a climate solution. So that includes, investors who are in the NetZero Alliance or are kind of aligned on progressing towards decarbonization. Banks, particularly European banks, who are increasing their sort of sustainable product line for their clients. And even new investors who are entering. So, for example, very significant corporates who have taken on large net zero commitments are now interested in investing in our institutional funds as a way to, develop kind of carbon projects or really get the carbon removal technology, as it were, like on their balance sheet. And so that's been kind of a very new development for us. So I think for institutional investors, it's this interesting thing that's happening, I think, around the investment model. They're thinking about how to maximize forestry NPV, both through the kind of the optionality between kind of timber production and climate mitigation. Yep. Some investors are now thinking about climate mitigation on their balance sheet through these forestry investments. So, if we think about the asset class today, right, it's $100 to $200 billion asset class, mostly in mature markets like the US and Oceania. But what a lot of the modeling shows is that, once you get to $20, $25 per ton a carbon price, it's actually a tipping point where you really start to pull land back into not only conservation, but into restoration. So if you're thinking about a world, which is not hard to imagine, where carbon is priced at $50 a ton or $100 a ton, that quickly transforms a forestry asset class into like $1 trillion asset class where conservation is driving the underlying thesis, and timber production becomes kind of a bycatch. So that's, I think, kind of, it can sound theoretical, but we're already starting to see this kind of new value system impacting forestry markets in the US, in New Zealand, And even now, as we're moving into increasing our emerging markets exposure, starting to impact our investment strategies there as well.
Nice. So if I understand it correctly, yeah, I mean, it's.
I guess what I'm saying is that the pie will grow bigger.
Yeah, the pie will grow bigger, and there is capacity in the market to handle the new demand from corporates looking to do it, especially if we get a carbon pricing. Richard, for a family to move to net zero, some asset classes. Are there some asset classes where that is more feasible than others? How do you look at that?
Well, let me pull back a little bit and get to net zero because, as I said, I think it's a newer topic, at least in sort of my part of the world. But whatever we're heading that direction, we're doing it anyway. So if we're investing in climate, we're investing in the environment. And then there's some very specific things with net zero that Radha and Son have talked about. One of the things we do first with the family is educate them. So we really think about what are the major drivers that are causing all of this. And when you look at it that way, you look at the planetary stresses and activism and policy, carbon pricing, the science and data, the NGOs, all of these areas, technology, of course, and then the markets, you realize that this is a phenomena that is not only affecting the planetary world and all of our species, but will certainly affect the investment world. And if you look at it, your own portfolio in many different ways that people really haven't thought about fully yet, because it hasn't been factored in. So the reason why I'm mentioning that is that my sense is that this will almost be a whole nother way of investing going forward. And I don't want to say the way, but could be, because it'll become more and more pertinent over time. So every asset class will be affected by this, both with risk and opportunities. That's a long way of me to getting to that. So even cash and short-term fixed income, the equity growth area, the private markets, real assets, of course. And Radha has an interesting point. We're talking to, we have real asset classes where we may invest in farmland or timber, but there's this hidden value of the carbon that's stored in the soil that hasn't even been expressed in the value of the land. I see Radha shaking her head, and that's going to be a huge play at some point from an investment point of view, but also obviously from the point of view of what's good for the planet. So there's a big movement in the impact space for regenerative agriculture in the United States and obviously globally. And so they were really thinking about how to keep carbon in the soil and how to have better soil and better farming practices for a holistic set of reasons. So we'll work in a traditional investment process with families that any investment manager or advisor normally does to invest in all the asset classes. So we'll assess the risks and get an understanding of where families may want to invest. We create an investment policy and we'll construct portfolios and we'll report on them. So there's nothing new there. But in terms of the number of sectors, there's so many, which is exciting. There's so many places to invest in all different types of securities and asset classes and managers. So traditionally you think of energy, and I think I know what the number is, but it's a huge number. 85% of investments have gone to renewables. And when you think about net zero, that's on the mitigation side and the sort of the CO2 that's going into the air, which is very important, obviously, but a lot of capital has got to shift to the other sides, which is either the other sectors that Radha mentioned, which are causing CO2 to go in the atmosphere, or pulling them back down. And that, I think, we'll move into that next trend very quickly, probably more on an institutional level first than a family level, but there will be opportunities in both mitigation and negative emissions, and either natural climate solutions, as Radha mentioned, or even negative emissions technologies, which I think will be probably the domain more of the large institutions and the large industries first, but we see deals in that space too. So, and some are combined, like bioenergy, carbon capture, that kind of thing. If you think about, well, what would be interesting or what could I invest in? You could look at it thematically. So I'm interested in the transportation space, and I want to be part of the movement from the internal combustion engine to the electronic vehicles and everything related to that. there's so much just right there, and that's probably one of the headline areas now, whether or not it has to do with EVs and AVs or batteries and charging stations or public transportation technologies and infrastructure. The water space is another area which is fully affected by climate, and all of this is related to net zero in one way or the other. If you're very tech oriented, there's going to be much more investment opportunity in geospatial and mapping and imaging, analytics that may come from drones or satellites, supply chain analytics, those areas which, I think, Radha and Sonia can talk about as well. And I think with Radha, how to measure sort of land and forests and assets there. Other areas like, the plastic area or the circular economy or waste to value, sanitation, recycling, all of these fall into the domain of the environment, and then climate, and then net zero. So I think there's a way to do it in every asset class, and and if you want to just go very thematic, there are ways that are broad-based as well as very specific in terms of direct investments or just direct categories.
So whatever the affinity of the family is, wherever they want to go, you can always link that topic towards a climate neutral investment strategy.
You can, and I think that there's, then there would be more vehicles for it as well. So there are ways in the United States to get pooled vehicles for a regular investment, to get into a mutual fund or an ETF or a money manager doing it. And then for sophisticated, wealthy families or other sophisticated investors, the private markets and direct investments, you really have to look just traditional investment approach, which is what's the right thing for me and my wealth and my sophistication and my ideas of risk. But there's a lot to invest in out there, and it just keeps coming, which is good.
Good. Yeah, you mentioned large institutional investors as well. Mm-hmm. So Sonia, from Allianz, you mentioned a little bit on asset allocation and the different asset class. Can you share a little bit more in detail what steps you're looking to take in the next years within these asset classes?
Mm-hmm. Yeah, so as said, we're going to kind of take it step by step in terms of asset classes, but I think what is going to change a bit kind of compared to what we have done before and how we come up with a strategic asset allocation, for example, I think it will be more and more important to really look into sectors. So I think there we see a big need to actually build up expertise, because very frankly, as asset owners, we usually are not, the experts in the different sectors. So usually the expertise is with asset managers, for example. Yeah. But of course, if we steer the portfolio and we know what, we want to achieve decarbonization, we also need to get a better understanding in terms of sectors and kind of also what is going on in the sectors, like how fast can they decarbonize? What is it that they really need from a financing perspective? So these are all kind of aspects that we further develop, be it at Allianz, but also within the Asset Owner Alliance with other asset owners. And I think, therefore, the view, I think, is going to shift a bit more and kind of deeper into the different asset classes, really into the sectors, and then coming up with what are potential solutions. And I think then there needs to be the link back to what type of asset class is then really suitable for various solutions. So I think to kind of, it's going to be a bit the other way around. So we're not going to probably come from the SAA and then kind of breaking it down into regions, but really also coming from the solutions perspective. And so I think this is going to be a big change. I also think that we will come up with new types of investments and solutions for us. So I think kind of solutions like hydrogen, like forestry, as Radha mentioned. I mean, these were usually not kind of, the types of investments that we were heavily invested in. I mean, we're usually kind of big on the fixed income side, and you know, kind of yeah, I would say, of course, a bit more conservative, being an insurance or yeah, or a pension fund. So I think also there the view, of course, is changing, and it is kind of a new field for us. But as said, I think we need some new structures to get a bit more comfortable with those types of investments. And as said, we kind of, you know, need the whole market to move into this direction. But I think, yeah, this is going forward how we will look at it. And I've also seen in the questions, if I may directly answer. So there was a question around benchmarks that I'm seeing on the screen. And so this is definitely also part, of course, how we look at those types of investments. So benchmarks are, you know, are a big part, also specifically for us sitting in Europe. And we know that, so for example, EU taxonomy regulation is coming. So of course, we also need to be in line. So not only to decarbonize and kind of go forward with that, but also be in line with the regulation that is coming. And so benchmarks are a big part of it, but I would say, you know, it's not only, so we wouldn't only rely on benchmarks and say, okay, you know, we're just going to switch the benchmarks and then we're on a safe side. So we really strongly believe that engagement and really direct engagement from us as asset owners, you know, as I already mentioned, with the companies, with asset managers, with kind of different stakeholders, this is actually the way to go. So, you know, we can kind of deepen our expertise, but we can then together come up with solutions also in terms of what is necessary and where there are gaps and how can we bridge the gaps in financing.
That is great. And it's also a great segue to our next topic of measurement and reporting, because how do you actually report your progress and where you stand towards your 2050 target? How do we know if it's, yeah, you're at 2035 or are you at 2037 in your progress plan?
Yeah, exactly. I mean, this is really a big question, because it always sounds like, okay, you know, they have a target till 2050. That's kind of 30 years from now. So, you know, are they going to do something, or are they going to wait till 2045 and then just kind of cut out the most emitting stuff? I mean, that's obviously not the way to go.
Yeah.
And therefore, so we have broken down the targets into 5-year targets. So next year as Allianz, we will come out with our first target for until 2025. And we will report on a 5-year basis. And as I said in the beginning, so kind of a rough number that we already know where we need to move to is that, for the 5 years, we would expect something roughly at around 25% of emission reductions in the portfolio. So this is definitely something that that we will report on. We will report on the progress there. We will also report on the sectors as said. So what are the sectors that we're concentrating on, and what is happening in the sectors? We will report also on our engagement efforts. I mean, we do it already in our sustainability report, but of course this has kind of this broader ESG perspective, but here also specifically in terms of climate, and also reporting on kind of the trend of what are our investments in solutions. So from an Allianz perspective, last year we, for example, had roughly 30 billion of, I would call it, climate solutions in our portfolio. And of course, we want to have a positive trend there, and we want to grow the volumes in those types of investments. So this is also, you know, a point that we will report on, saying kind of what are the solutions that we have selected, and be it, you know, blended finance vehicles as said, because there we really see for us a way to go and to enable the inflows into areas that may be too risky without the blended finance structure for us. But also as said, I mean, hydrogen, new technologies, I mean, this is kind of still, you know, pretty new, and I think it's pretty new for almost everyone in the investment area. But yeah, I mean, we need to learn, we need to kind of stay a bit agile, I would call it, on the way. So it doesn't mean that now we have everything figured out and everything is carved in stone and that's now the plan until 2050. We will need to adjust going forward, but I think there is a very clear idea where we're heading to. And as said, the reporting will be there because, of course, I mean, we committed publicly, so we also want to make sure that we can show what is really happening in the portfolio.
Yeah, no, very, very clear. And Radha, I mean, you know where you stand, but you're also, yeah, looking at the reporting that you're setting up at New Forest. What were some of the main challenges you needed to solve in setting up your reporting framework?
Yeah, sure. I mean, so we have extensive reporting already around various impact and sustainability metrics, you know, how we engage with PRI reporting on an annual basis. We're now integrating, you know, TCFD related reporting across our portfolio. And increasingly, you know, we have a lot of our clients trying to get their heads around the climate benefit associated with their investments in forestry with us. But the biggest gap right now is to standardize carbon accounting in land use. So the biggest challenge right now is the fact that the GHG protocol, which is the most widely used protocol to measure emissions, currently excludes land use. So 25% of global emissions and 25% of the solution is now actually just excluded from the accounting methodology. And the rationale for this is political and longstanding and what have you. But the two organizations that run the GHG protocol, which is the World Resources Institute and the World Business Council for Sustainable Development, are now in the process of rectifying that. So they're actually developing a carbon removals standard that will look at biogenic emissions. And in fact, New Forest, we're on the technical working group for that. And the expectation is hopefully by the end of this year or right at the beginning of next year, this will be released. So the thing that's really important about this is that it will, deal with Scope 1 and Scope 3 emissions. And importantly, also consider not just the flux in carbon in the landscape, but also things like carbon storage in durable wood products. So the fact that you cut down a tree doesn't mean you suddenly have emissions. You've got carbon storage in furniture and flooring, the built environment. And if you think about mass timber and more skyscrapers built with wood, it's important that we're thinking about that carbon stored in that built environment. So we already do carbon accounting, but certainly having this standard protocol for everyone in the sector will really allow asset owners to compare companies, to compare managers, really on an apples to apples basis. And even absent any kind of carbon pricing, it should, in this kind of world that's going towards net zero, start to give some transparency around who's managing land assets sustainably from a climate perspective and who isn't.
Yeah. Oh, clear. And Richard, I mean, I assume you have to aggregate reports from different providers to different for your clients. What could some of the fund managers in the audience today do to make your life easier?
Well, first of all, I think that the fund managers, the companies, and the sort of the ecosystem around them is getting extremely sophisticated. We're seeing just continued initiatives and movement towards data and different ways to express it. And so it's not like there's not enough information at all. I would say that there's not a consistent language of information that we can all translate. So it's very exciting when we talk to each manager and find out how they're maybe viewing success or risk or reporting or impact And then you have to map it out against everybody else, and then you have to put it and look at the client's portfolio as a whole. And it probably goes from a sharp pencil to a crayon at the end. It just, there's no, and I know a lot of people are trying to develop the perfect solution, and I'm sure all that will come too over time. So we're just in the middle of that second or third inning in baseball in the United States. It's kind of the first major phase of it. So I think that what can they do? I think that the impact investors are interested both in the financial returns, which the industry is pretty good at. We've got that, and the impact returns. So the ways that they are expressing it, and then the ways that we can translate it back to the families, so that we can say, you're gaining success and positive impact by decarbonizing, by moving towards solutions, and by engagement. And so it may be that for a while it's going to be different for a lot of people, and then in a few years it'll start to sort of converge into some sets of standards and languages. I think the really cool thing about net zero is that and I've been in the space a long time, like you all, it's just hard to translate 1.5 or 2 degrees to investments. They're different things. And so as we move to net zero, there's something that's a little bit more tangible there, which is we're going to put less up there in the atmosphere, and we're going to take more down, right, of CO2 equivalent. And you can see a number there, and you can see the source of that, and you can see the way to sort of mitigate it or bring it back down. And that to me seems more tangible and constructive, and in terms of reporting, may be easier as well. And so I do think that hopefully that there'll be more reporting along those lines. So you can say, look, I've really made a positive move of emitting less, of moving towards more positive solutions, of removing more. And when you start to go to the removal side, then you think, well, if that's important and I care about that, and that's a good investment, right, then what are the areas to do it? And you know, so Radha mentioned the nature-based solutions has got to be a huge part of this. And with real assets as an asset class that's important anyways, it doesn't necessarily correlate with other asset classes. In a world where there's going to be a lot of flux and potential scarcity, it could be a very good investment, you know, regardless. And then you add the impact to it as well.
Yeah. So thanks for that. As a reminder for the audience, if you have questions for the panelists, feel free to put them in the Q&A, and we will see them. Sonia, some good news. It looks like a lot of organizations will be joining the Alliance, because the results from the poll at the beginning of this webinar is 98% expect that their investment organization's portfolio will be net zero by 2050. So it's 0% expected, definitely not, and 11% maybe. So overall, those are some very encouraging comments. So if you have questions for the audience, feel free to put them in there so we can go through that. Sonia, for an organization that isn't part of the Alliance yet, is listening, wants to join this Alliance, what would be your recommendation for them?
Yeah, so I would really encourage every organization, so every asset owner, to join, because I kind of, I can kind of maybe shed a bit light on more things, what I've already heard, because I also had various discussions with asset owners who joined or who intend to join. And I think one thing is, what is really great about the Asset Owner Alliance is that, I mean, it is an initiative, but behind this initiative, there are clear steps that we want to take. So it's really, not, I would say, not just talking and kind of having this great ambition, but then speaking about the boundaries and why can't we do it, but rather finding ways, how can we do it? How can we decarbonize? And therefore, even asset owners who may not be that far on, I would say, on the journey of decarbonizing, or do not have you know, a lot of experience, but they know they want to decarbonize. I think it's really a great place for them because, as I said, it's very collaborative. We do and really work on approaches together, and kind of everyone is heard within the Asset Owner Alliance. So it's not only, you know, that like Allianz would say, okay, this is how we should do it, but it's really kind of collecting the different approaches. And the idea is that it's probably not going to be a standard that the Asset Owner Alliance can set, but it can be of ring fencing of various approaches that would work, but, you know, kind of, there of course might be slight differences how asset owners want to approach their portfolio. And so I think you can really use this this alliance as a think tank, really as you know, exchanging and together kind of learning about you know, new technologies, and really bringing it in. How can we make sure that we can enable the inflow? So there is a lot of help, and it's I think it's also kind of a new, yeah, I would say it's even a new thing within the asset owners, because at least for me, I feel it's really the first time that the asset owners are coming together and really exchanging on, and really opening up. I mean, it doesn't mean that, of course, we know about each other's portfolios, of course not. So I mean, there is a certain boundary there, of course, also from a legal perspective. But I think it's really important to learn from each other, and to really be open and work together, and kind of come out of those silos also. And I'm really very excited about what we do in the Asset Owner Alliance, and I can highly recommend everyone who is interested to approach us and really have the discussion, because yeah, it's really very valuable experience.
Yeah, no, thanks for that. One of the things I was really impressed with looking into this is how, like you said, it's not like, oh, let's make a statement and then nothing happens and we say, oh, it's so difficult, but it's really made practical on, hey, this is what we'll do by then. This is what we'll do by then. And I think that's a great step forward in this industry, and also for me, the first time I've seen this. Richard, there's a question.
Sorry, maybe one thing to add. Yeah. Sorry, Richard.
Go ahead.
What I would really like to stress out is that sometimes I think it sounds for some of the asset owners that, okay, in the Asset Owner Alliance, there are only the companies that, you know, have it all figured out now, and they know exactly what's going to happen. And I really want to encourage everyone, because it's not true. I mean, yes, I said we're going to break down the targets into 5 years targets, but of course, I mean, if you ask me what exactly going to happen in 2040, I can't really tell you, because, you know, we're not there yet, and there are still so many things open, and we need to work on so many things. So it's not that we have it all figured out, but we take it step by step. And therefore, I would really like to stress this out, because some of the organizations are maybe a bit hesitant, and they feel they're not, you know, that far. I mean, that really doesn't matter. I mean, as soon as the organization really wants to work on it and wants to participate, we're very happy.
That's always encouraging to hear. Richard, there's a question from the audience on risk management and diversification. And are you also looking to include regenerative agriculture in this space?
Yes, absolutely. It's not only because it's a favorite of mine, and it's a very big trend, and I think there's a lot of very high impact oriented people in the space, but from an investment point of view, and of course you have to sort of size up the kind of investment and what underneath it, and the manager and the strategy, et cetera. So, but investing in either the space, for instance, as Rod has mentioned, or natural solutions, land, all the areas of real assets is in itself its own asset classes. So even if you took the conversation of net zero and climate out of it, there is an allocation for, or could be an allocation for families into real assets and into timber and agriculture, et cetera. And now you're adding on this. Now, this also means that if you take a holistic view, there's a lot of different ways to enter the regenerative space. You could think about it in terms of the soil and improving the health of the soil and the land itself and what it's producing. But regen goes beyond that, because you think about the community around it, obviously the farmers, the community around and the supply chain of that, the local community where it may reside. And you think about also the areas that might be a little bit more about infrastructure and technology related to this. So there's a movement that's a little more high tech into, you know, how to plant more efficiently, water, using technology to look at pests and problems. And of course, then whether or not you feel this is regen or not, there is this larger movement also into indoor farming, which is going to have to complement traditional farming anyways. And you can argue whether or not it's completely regenerative or not, but it's certainly sort of all part of this bigger space of moving into these real assets in land and agriculture.
And finally, to conclude, Radha, say, all the asset owners move in this directions, and in 2030 we are there with the natural land use. How does our natural world look? Can you paint a picture on how our environment in our cities, in our parks, in our countryside looks versus how it looks today?
Good question. I think that, so first, we will have, you know, protected our remaining biodiversity hotspots and carbon hotspots around the world. So from our forests in Central Africa, the Amazon basin, the Amazon, you know, parts of Borneo, that will have happened. I think the other piece of the puzzle will be that there will be a lot more partnership-based models where we're bringing small community holders, small landholders and communities, and you know, across Asia, farmers in the U.S. and Australia, where we're really integrating into these broader landscapes, you know, sustainable agricultural production and restoration. I think that's going to be a very significant transformation. And I think we will really have a lot more very highly productive systems around agriculture and forestry. So we might be looking at, you know, tripling our plantation base across the tropics. And as Richard mentioned, hopefully in, you know, urban areas, we're using, you know, defunct malls and what have you for vertical farming and things like that. So so I think it's really going to be a much more thoughtful land use planning and productive use of our scarce resource, which is our, you know, our ecosystems. That's ultimately, you know, what we're going to have to move to over the next 10 to 15 years.
Thanks for that. That definitely sounds like the world we all want to live in. Thank you. This concludes our panel. I'd like to take the opportunity to thank all our panelists for being with us here today, and everybody watching as well. And please dial in tomorrow as well, when we look at impact assessment frameworks and uncovering greenwashing. Thanks a lot, everyone.